Bismillahirrahmanirrahim. In this slides or in this lecture, I will discuss the numerical which I have given you as a assignment, and the majority of have not been able to do it. So I will be discussing the question, and after that I will be discussing the whole procedure and the solution to that numerical. First of all, we will discuss the question in detail. In April 1994, Novell Incorporation announced its plan to acquire WordPerfect Corporation for $1.4 billion. At the time of acquisition, the relevant information about the two companies were as follows. So Novell is about to acquire WordPerfect, and they want to see that whether this deal would be worthwhile or not. So based upon that, they have gathered information which is actually available. So revenues of Novell were $12 million and $1,200 million, and WordPerfect was $600 million. Now cost of goods sold is 57% for Novell and 75% for WordPerfect. Depreciation is $42 million and for Novell, and $25 million for WordPerfect. Tax rate is 35% and 35% for both the companies. Capital spending is $75 million for Novell and $40 million for WordPerfect. Working capital as percentage of revenue is 40% for Novell and 30% of WordPerfect. The beta is 1.45 for Novell and 1.25 for WordPerfect. Expected growth rate in revenues is actually 25% for WordPerfect and 15% for 25% for Novell and 15% for WordPerfect. And expected growth period or high growth period is 10 years for both, and years after high growth period is 6%, but growth is actually then beta after high growth period is 1.10 for WordPerfect and Novell. Now capital spending will be offset by the depreciation after the high growth period. Neither firm has any debt outstanding. The treasury bond rate is 7% and risk premium is 5%. You have to estimate the value of Novell operating independently, and estimate the value of WordPerfect operating independently, and we have to estimate the value of combined firm with no Psi Energy. And as a result of merger, the combined firm is expected to grow 24% a year for high growth period. Estimate the value of combined firm with higher growth. What is the Psi Energy worth, and what is the maximum price Novell can pay for WordPerfect? So that was the question. Now first we have to do is we have to find out the values of Novell and WordPerfect for next periods, because we know that they are going 25% is growing Novell, and 15% is and WordPerfect is growing with 25%. So in the next slide we will see the solution of this question. Now our main requirement is that we want to find out the free cash flows. So because once we find out the free cash flow, so we will increase that free cash flow with 25%, and we will get cash flow for each period. And in this question they have actually identified that this firm has a growth period of 10 years. So this question will be automatically solved like the growth phases of question. So for this first growth phase is in which it is being growing, Novell is growing 25% and WordPerfect is growing 15%. After that, the growth will be 6% for unlimited time period. So first of all, what we'll do is we have to find the free cash flow for the first period. That is actually we have already know that how we will determine the free cash flow. Novell would be growing, the revenues of Novell will be growth with 25%, and obviously we have to find out the percentage given for cost of goods sold, and after that 25% of depreciation will be increased, and EBIT will be increased, and so on. We have to calculate, then we have to deduct depreciation, capital expenditure, and we have have to add depreciation back because we have to find out the free cash flow, and working capital as percentage of revenue would be deducted, additional revenue which we have, and what would be the working capital for that. So we will deduct that. So for the first period, we will get the free cash flow $223.875 million for Novel, and 49.4375% for WordPerfect. And this same would be goes for a combined firm, because for combined firm they have already mentioned that the combined firm will be growing with actually 24%. It will have a growth rate of 24%. So we will be using that information, and based upon that we will determine the free cash flow for the combined firm as well. And what about the cost of equity in growth period and cost of equity after the growth period? So that thing, as they have given us the beta for both the firms, so based upon that we will determine the cost of equity for both firms. And it actually a cost of equity is cost of capital of this firm, of both the firms, because they are not using any debt. Therefore the cost of equity will be treated as cost of capital over here. And they have given that 7% is the is actually the return with the risk-free rate, and 5.5% is risk premium. And for Novel we have 1.45 beta, and for WordPerfect we have the beta is 1.25. So based upon that, taking 7% as your risk-free rate and 5.5 is a risk premium, the beta will be multiplied with a risk premium, and then after that the result would be added with your risk-free rate. So the cost of equity in growth period of for Novel is 14.975, and for WordPerfect is 13.875. And cost of equity after growth period actually would be determined by, because as if they have given 1.10 as the beta for after the growth period. So based upon that we will determine the cost of equity after growth period, like 7% would be the risk-free rate, and 1.10 would be the beta, and multiply it with the risk premium, that is 5.5%. So we'll get 13.05 for Novel and 13.05 for 13.05 for WordPerfect. But when it comes to the combined firm, so the case is a little bit different for combined firms, because we cannot find the cost of equity in growth period or cost of equity in after growth period for combined firm unless and until we can find out the actual value of firm of Novel and WordPerfect, because after finding the value we will determine the proportionate contribution of both the companies in the total value of combined firms. And once we find out that, then we will multiply that proportionate with your betas. Like for example, Novel has 1.45, so we will multiply the portion of Novel with that, and 1.25 of WordPerfect, so we'll multiply that with that. But in case of combined firm, in case of after the growth period, so obviously we will proportionate would be divided by 1.10 with Novel and 1.10 with WordPerfect. So that would give you the same result, that is 13.05. But for in both the cases we can determine the cost of equity for combined firm after finding the value of Novel and WordPerfect separately, independently. So what we will do is that then after that we will be able to determine the cost of equity for combined firm in case of growth period and in case of after growth period. Now, in order to find out the value of both the companies, first of all, as we have determined the we have determined the value of the value of free cash flow for the first growth period. So after that we will grow it with 25% each period, and we will get the values for the next 10 periods. And after that we will also have to get the value of the 11th period in order to find out the growth, which is actually for unlimited time period. After that we will, as we have the cost of equity available, with the help of that cost of equity we will find out, because the cost of equity is the cost of capital, because this company is using no debt. In that case, what we will do is we will take this free cash flow divided by with the cost of capital, and we will get the present value, and so on we will do it for the next 10 period. Obviously the discounting period will increase with the passage of time, but for the 11th period, what we'll do is we have to find out the terminal value. And terminal value is actually being is just like the value finding for unlimited time period. For example, value at the 11th period divided by the cost of equity for the cost of equity for the for the 11th period minus the growth period of that thing. So with the help of that we will get the terminal value, that is 13.13556.0021, and then we'll discount it, and after discounting then we'll get the values, that is the value of the firm is actually 6276.48. So if the sum of the values of 10 years is 2919.8.2, and present value of terminal value is this 3356.669, so we'll get the value of the firm, that is 6276. The same procedure would be applied for the second firm, and the same thing would be, we'll do the first we will find out the future cash flows, future free cash flows, and in this case we have a growth percentage is 15%. And after that, with the help of cost of equity, which is actually the cost of capital as well for this firm, so we will find out the present value for each. Then after that the same procedure will be applied for the terminal value, and we'll add all these present value that give us 450.48.4862, and then we'll find out the present value of the terminal value, that is 381.661. We'll add up this, then we'll get the value of 632.1481. So this is actually the value of the firm value of the firm, both firms. These values then help us to determine the cost of equity for the combined firm, and as I have discussed that we'll add these thing, and for proportionate we'll add 6276.41 plus 632.1481. We'll get 7108.629, that is the total combined value. Then after that we'll find the proportion, that how much contribution is the is a novel, and what is the contribution of word perfect in this whole value. So then we'll get the proportion, and the beta would be multiplied by that portion, and that beta value would be used to determine the value of cost of capital or cost of equity for the combined firm. In case of finding the value of combined firm without synergy, what we will do is we'll just add the values of both the firm. That is as we have determined the value of word perfect, that is 6276.481. We'll add with the value we have calculated for word perfect, that is 832.1481. So we'll get the combined value, that is 7108.629. That is actually the combined firm value without synergy. But as they have added, or they have given in the question that this company will grow with 24%, so based upon that we'll find the free cash flow for combined firm in the for the fourth requirement, and we get the free cash flow for the first period of the combined firm, that is 276 million dollars, and obviously we'll grow it with 24% till 10, and based upon the values I have given. So what we'll do is we'll find out the combined firm value, and with the help of the cost of equity we have determined, we'll get the present value, a terminal value, and adding the present value of all the free cash flows and the terminal value, we get the combined firm value of the word perfect and novel. That is 7,745.595. Now, the last two um, questions are that what would be the value of Psi Energy? So, in order to find out the value of Psi Energy, what we'll do is first, as we have find out the value of Psi Energy by calculating the value of combined value of combined firm with 24% growth rate, and we'll get the value of combined firm with synergy, that is 7,745.595, and we'll deduct the value of the firm that is actually calculated by just combining the independent values of both the companies, that is 7,180.629. So we'll get the combined the value of synergy, that is $636.96 million. Secondly, they have asked that what would be the maximum price for word perfect. That means that as if the novel wants to purchase this company, so what a maximum price the novel should pay. So as we have calculated the value of synergy, so the synergy gain which the novel would get would be 636.96 million dollars, and actual jo value that was actually of were perfect at that time was 832.1461, considering all the relevant information, and adding both we'll get 14,469.11 million dollars. So that is the maximum price. If this they are paying this price, so obviously they'll be getting the benefit, but if they are paying more than that, so that would be not beneficial for a novel. So the maximum price the novel should pay for word perfect would be 1,469.11 million.